A futures contract can drain cash before expiration. That's the obligation a price quote can hide. Stay with us for one translation that matters more than any chart: how a quoted move becomes a dollar obligation under the actual contract terms.
So when someone says they bought futures, what'd they buy? A company share, the commodity, or a promise?
Usually, they've entered a standardized futures agreement. Investor.gov describes a commodity futures contract as an agreement to buy or sell a specified quantity at a stated price on a particular future date. That's a different legal shape from owning a stock share.
The contract is standardized, so participants are looking at the same basic terms. The specification tells you the underlying reference, the unit, how price is quoted, the minimum increment, the expiration, and how settlement works. Read the specification before treating the quote as self-explanatory.
Start with the contract unit. It tells you the amount covered. Put the price increment, multiplier, expiration, and settlement method beside it before you decide a quote means anything financially.
Erica, what could make two contracts with the same looking price chart create wildly different dollar results?
They're units and multipliers. A point or tick's a price language, not a dollar language by itself. The contract specification supplies the conversion. It's also why comparing screenshots from different futures contracts can mislead a viewer before they've compared like with like.
Long and short describe the direction of price exposure, not a personality type and not a recommendation. A long position generally gains when the contract price rises and loses when it falls. A short position has the opposite directional exposure. Both are bound to standardized terms.
That makes a short position more than just a negative opinion. It's an obligation with the same need to understand the contract math.
Use a deliberately hypothetical example. If an imaginary contract says each 1-point move equals $50, then a 4-point adverse move changes that position by $200 before any commissions, fees, or other account terms. Change the multiplier and the dollar result changes too. This is mechanism, not a trading suggestion.
That example has a discipline built into it. It starts with a defined move, a stated multiplier, and plain arithmetic. It does not smuggle in a forecast, a target, or a claim that the same move will happen tomorrow. The calculation is a comprehension test. If you cannot reproduce it from the contract, you are not yet evaluating the position in dollars. A useful order is identify the unit, identify the minimum move, find the multiplier, then calculate a defined move in dollars. Don't reverse that order by seeing a deposit amount first and assuming it measures the whole risk.
Futures can also settle differently. Some contracts have physical delivery rules, others settle in cash according to the procedure written into that contract. A familiar commodity name does not tell you which path applies. The exchange rulebook and specification do.
So if I only know the symbol and last price, I don't yet know what I'm dealing with.
Exactly. Put it in a comparison, not a slogan. Stock ownership is a claim on a company. A futures position is a standardized contract whose terms govern a future transaction and daily account effects. Neither label answers whether it fits a person's goals or cash flow.
That is step 2 of the investment map. Know the claim. Before any opinion about direction, identify what the position gives, what it requires, and which document controls each term.
The screen is the invitation. The specification is the answer key.
And the answer key is contract-specific. A commodity, currency, interest rate, or index futures label can sound familiar while the unit, expiration, and settlement mechanics differ. That is why the exact exchange page and exact contract month belong in a written note, not just a browser tab left open beside a chart.
Nora will show why the account can change before expiration. What term changes a quote into dollar exposure? Margin isn't a bargain sticker. It supports a changing obligation. Real quick, because this next part matters to you. If any of this is helping, tap that like button, then hit subscribe and ring the bell so the next one finds you. Both are free and take about a second, but they tell the algorithm to show this to one more person who needs it. A futures account can receive or lose cash before expiration. Professor Adeyemi studies market structure and that daily accounting is where the small deposit story breaks down.
Margin is a performance bond. It supports the obligations of the position. It's not a down payment that makes the contract inexpensive. The amount is connected to a contract and account rules, while the economic exposure can change as the market changes.
So the responsible question isn't how little can I put down? It's what can this position require after it moves?
And the word margin has two checkpoints. Initial margin is required when a futures position opens. Maintenance margin is the minimum amount that must remain on deposit. Those are terms the CFTC glossary separates, and the actual amounts can vary by contract and broker.
Nora, that is why a universal margin percentage would be bad education. The exchange sets requirements for its products, and a futures commission merchant may require more under its own rules. Viewers need the current specification and their broker agreement, not a number copied from a comment thread.
Now add daily marking. CME explains that its daily settlement price determines daily profit or loss and any required margin adjustment for open positions. The CFTC glossary describes mark-to-market as a daily cash flow system. Gains are added to the account and losses are subtracted.
Professor Adeyemi, start with opening the position under current margin terms. Then follow the daily settlement, the credit or debit, and the equity check. The point is to see why an open futures position can create a cash flow event before the final contract date.
I want to interrupt the comforting version of that story. Daily settlement doesn't wait for someone to feel ready. That is the point I am holding on to. Evaluating only the entry can miss the path between entry and expiration.
Correct. The contract and account process continue on their schedule. That does not mean every move creates a call, but it means the account process needs to be understood before the final date.
If adverse movement takes account equity to or below maintenance margin, the CFTC glossary says a margin call is issued. The specific notice timing, permitted collateral, and broker actions are not generic facts. They belong in the current broker agreement and disclosures.
That boundary matters in real life. A viewer can learn the CFTC definitions here, but only the current account documents say when a particular broker communicates, what it accepts, and what discretion the agreement gives it. If those terms are unclear, ask the broker to identify the controlling document before treating an in-app message as the whole rule. A margin call isn't a prediction that a market must keep falling. It's an account requirement created by the position, the price move, and the applicable terms. That distinction keeps a viewer from answering a cash flow problem with a market slogan.
Make that practical. What would I write down before I even consider a leverage contract?
Write the exact contract, unit, multiplier, initial margin, maintenance margin, final trading date, settlement method, and the broker's funding and liquidation terms. Then add a defined adverse move calculation. That is not a trade plan. It is a record of what the contract could ask of the account.
A hedge and a directional speculation can use the same futures contract, yet they begin with different circumstances. A business may be trying to reduce a price uncertainty tied to its operations. A directional position accepts price risk to express a market view. Same instrument does not erase that difference.
So used for hedging does not make the instrument automatically low risk for a person copying the symbol.
Right. Purpose, scale, cash flow, and expertise change the context. We can explain the vocabulary, but a viewer should bring personal suitability questions to a qualified financial professional and broker-specific terms to the broker before taking leveraged risk.
Notice how much of the decision sits outside the chart. Dates, documents, account rules, and cash availability. Those are not boring extras. They are where a position can stop being theoretical.
Professor Adeyemi, thank you for making clearing sound like an account process rather than a mysterious backroom.
Read the process before you rely on the price.
Now take that process out of the studio and into a simple document routine. Identify the contract, translate its exposure, then ask the right owner the right question. The first useful futures decision may be to stop at the specification. A quote can be easy to find. The terms that define the obligation deserve the slower read.
Give us the order. I do not want a vague warning. I want the first 5 fields a viewer should locate.
Start with the exact contract and exchange. Then locate the unit, minimum price increment, multiplier, expiration or final trading date, and settlement method. Those fields tell you what the contract covers, how its price moves translate, and when the process changes shape.
A named example helps. Dana, a first-time investor comparing 2 futures quotes, sees similar chart movement but different contract units. Dana does not need a prediction to learn something useful. A defined price move can carry different dollar consequences because the contracts are not identical.
That is the moment people often skip. They compare the quote instead of comparing what one point actually means.
Use a contained calculation, not a forecast. Take one stated price move from the specification, multiply it by the stated contract conversion, and label it hypothetical. Then ask whether the account could absorb that movement alongside rent, debt payments, emergency savings, and other real obligations.
But the closing path is separate from the multiplier. Is there cash settlement or physical delivery? What is the final trading date? Is there a delivery notice date? Which time zone and trading hours apply? A deadline does not become less real because it is buried several links into a contract page.
And broker terms can change the operational answer. The exchange rule tells one part of the story. The broker agreement tells me what that broker may require from my account.
Chris, that is the right distinction. Ask the broker how it calculates and updates margin, what notices it provides, what collateral it accepts, and what its agreement says about reducing or liquidating positions. Write down the answer with the exact contract name and date, because rules and requirements can change.
Chris, if the broker cannot point you to a document or the answer changes with the contract, write that down too. A clear record of uncertainty is better than turning an incomplete answer into certainty. It also gives a qualified financial professional the actual inputs needed for a personal discussion instead of a remembered fragment from a screen. Then check the source behind the person or firm. Investor.gov identifies the CFTC as the federal futures regulator and directs investors to National Futures Association registration resources. Registration can help identify a professional or firm. It does not predict performance or replace reading the documents.
That sounds unglamorous, which is exactly why it is useful. The record check is more durable than a confident pitch.
A quick myth check. Margin is not a maximum loss label. It is a deposit or collateral requirement supporting the position. The loss shape depends on price movement, contract terms, the account, and how the position is managed under applicable rules.
Keep a small record folder, the contract specification, the broker agreement, the current margin schedule, your written questions, and the answers you received. If a source changes, date the update rather than relying on memory or a saved screenshot.
This is step 5 of the investment map. Read the terms. It is not a ritual before action. It is where you learn whether the contract's unit, settlement path, daily marking, and broker rules are even understood well enough to discuss.
And if the questions are personal rather than mechanical,
match them to the right owner. Ask a broker about its platform and agreement. Ask a bank about its own account products. Bring suitability and goal questions to a qualified financial professional and tax reporting questions to a qualified tax professional. None of those professionals can replace the contract specification itself.
that handoff changes the question from "tell me what to do" to "help me understand this exact obligation." It is a better starting point for a broker, a professional, or a tax conversation because the contract, the account terms, and the viewer's own facts are no longer all mixed together.
That division prevents a common error, expecting one convenient answer to cover exchange rules, broker operations, taxes, and an individual budget. Those are separate questions with separate owners.
Our narrow verdict: futures are standardized contracts, not a shortcut around understanding risk. They can serve different purposes, but leverage and daily marking make copied confidence especially fragile.
My practical recommendation is to pause before any leveraged contract until you can explain its unit, multiplier, settlement rule, margin terms, and adverse move dollars. If this made the documents clearer, like and subscribe to Investing Explained for practical financial vocabulary without the product pitch. Which contract term would you verify first? Keep the decision yours, keep the terms close, and take care until the next question.